Lots of questions then still, in particular surrounding the AstraZeneca-Oxford vaccine. Joining us now with an investor perspective on how we navigate a path through the winter here, Bilal Hafeez, Hive founder and CEO and editor. Bilal, very good to speak to you once again. So as we look at this sort of medium-term optimism, I suppose, around vaccines, notwithstanding questions around efficacy, maybe around Astra and Oxford, there does seem to still be medium-term optimism, but short-term, a lot of pain, a lot of tragedy, actually, human tragedy, but also a lot of concern for how difficult the winter becomes. How do you go about thinking through the short-term difficulties and the medium-term optimism and balancing the two?
And that's a very good question. I mean, the first thing I would say is that, because we're in the second or third wave of the COVID virus, markets, it'll have less of a negative impact on markets in general, leaving aside the vaccine. It's always the first cut is always the deepest. So March, April was a period of maximum uncertainty. So we have less uncertainty around COVID. The lockdowns are a bit more smarter this time compared to the first one. So a general observation is that even without the vaccine, a second, third wave would have less of a negative impact on markets. The second point I would make is that the vaccine, I think, is very significant in the sense that one should, in general, weight much more towards the vaccine side of the story than the current COVID case side of the story. Because if you know that you have a vaccine that will be distributed at some point over the course of next year, that gives you a lot of certainty about how long these lockdowns will last. So my bias in general is generally to weight much more towards the vaccine than the current COVID cases. That said, we do know that the winter period will be quite difficult. So, geographically, one can then say that perhaps one should weight towards countries in the southern hemisphere who will be going through the summer. So whether that's South America, Australia, New Zealand, those sorts of countries. So there could be some sort of, some nuances there. And then the other point I would make is that there is, from a purely markets or economic perspective, what matters is not just the COVID cases and unfortunately the deaths, but also the lockdown measures. How much does the current COVID second or third waves have an impact on economic activity? And there are major differences around the world. So Europe is much more strict, the US less so, and so that will then be represented in the economic data.
Yeah, so you might want to think about the seasonality. That's a really interesting point, Bilal, which hemisphere you're operating in and investing in. And you also might want to think about the various geographies and the restrictive measures introduced. Even within Europe, Bilal, do you see big divergence, or would that be to overstate things? I mean, the most recent news points have suggested that the UK is loosening a little, that France is loosening a little, Germany is maintaining its stricter stance ahead of Christmas, ahead of the holidays. But maybe that's too simplistic. I mean, what do you expect to see as things develop through the winter in Europe?
No, that's a fair point. I do expect a loosening of some of the measures as we get closer to the Christmas period, and probably in most countries. You have to remember with Germany, the level of restrictions wasn't as aggressive as some of the other countries in the first place. But I do think, just like we've seen with the UK, there are some lifting of restrictions as we go into the Christmas period, because many of these countries recognize that, one, from a retail perspective, Christmas is an incredibly important, stage for businesses, but also from a cultural perspective, it's a time off for people. And what we have seen with the lockdowns, and if you look at the political responses to the current lockdown measures, there's less support for lockdowns this time around. And so the governments across Europe have to be very careful about keeping the public on side. So I do think there will be some sort of loosening as we go into the Christmas period.
And for those watching this in London, and there'll be a few, London is going to enter Tier 2. We found that out in the last hour or so. England's middle level after this lockdown Mark 2 is removed. As we look at all of these measures and what this does to our ability to get out and about, Bilal, as we enter into December, do we risk missing the bigger picture changes, the big structural shifts? And of course, we talk about those as well. But is that where your thought process goes? How much of this work from home, which I'm enjoying so much this week, how much of that work from home will live on into the post-pandemic era, and what big changes that could make for investment strategies?
Yeah, absolutely. You know, my kind of sense, and this is something I'm telling all kind of investors and clients and so on, is that, you know, for me, the bigger story is not so much, you know, the current kind of lockdown measures or the vaccines even. It's more about what's going to be the enduring impacts of 2020 on our lives. And in some ways, if you kind of step back and think about this, what happened in 2020 was essentially the world went on pause. It was like a major reboot of the world where everything stopped. And everybody had to suddenly find a way of working when you weren't able to be mobile, which essentially meant a mass widespread adoption of existing technologies that weren't adopted before. And this is in some ways quite revolutionary. And what we're finding is, and this is a lot of academic work has come out on this very recently, is that a lot more people have discovered that they can work remotely. And managers previously who were very skeptical of remote working have suddenly said, actually, it kind of works. And in fact, most have had a positive experience from it all. So I do think there will be this enduring impact on the labor force where we'll see much more remote working. And if we do see that, that has some significant implications. One, it has an impact on cities versus smaller cities and villages and so on, where people will now find it more comfortable to live outside of big cities. Also, people will have access to jobs that they didn't have access to before because they can now access it remotely. So that sort of opens up the opportunities that are available. So I think these will have some quite profound impacts on markets.
Yes, I'm sure it's a short-term phenomenon in my industry, but I'm sure for some industries it will have long-term impacts. And the distribution of wealth around various geographies could be really interesting to watch. Bilal, we talked a bit about the virus and how it's managed and how that impacts on investment strategy. What about the impact that it's having on inflation? I know that you've been giving some thought to the way that the service sector has been hit through the pandemic and what impact that should have on our inflation expectations. Can you link up some of those thoughts for us?
Yes, absolutely. Of course, you know, one of the biggest debates at the moment is will inflation go up or will it fall in the period going forward? The people who are very bullish on inflation or expected to go up are focusing a lot on the build-up in debt, the amount of printing by central banks. But for me, the most important thing is much more to do with the supply side aspects of the virus and which part of the economy is affected the most. And unlike any other recession, it's a service sector that has been completely negatively impacted during the COVID period. So that's the part of the economy that has really dropped significantly, whereas manufacturing held up. And if you look at inflation in advanced economies, in rich countries, most of inflation is service sector inflation. And so it's really, and if you go back over the last 10, 20 years, the only area of inflation we have seen in rich countries has been service sector inflation, whereas goods inflation, you know, the cost of TVs and such things have been close to zero. So my sense, first of all, is if it's a service sector negative shock, therefore, you should naturally see a downward pull on inflation. And then longer term, my point there is that within the service sector, the technological adoption that you've seen over the COVID period should structurally lead to lower service sector pricing pressures going forward.
Yeah. It's really interesting, isn't it? Because we were dealing with low inflation and lots of questions as to why that was, even before the pandemic, weren't we, Bilal? And now we've got added dynamics to consider. And I wonder if one of those is the news about the vaccine and what that does to people's propensity to consume, to consumers and also to investors' propensity to invest, businesses' propensity to invest, rather. If you know that the vaccine is coming, does that change things? Does that add a little bit more pricing power? How do we deal with that vaccine news flow when it comes to inflation expectations?
Yeah, no, that's very true. I do think that, you know, this will lead to a build-up in demand and greater optimism and greater investment and so on, which could, in the short term, have somewhat of a positive impact on inflation. So there could be a bit of a pull up in inflation, and there's certain base effects that will see inflation pick up. But already, you know, a lot of that is likely to be seen through commodity inflation. So oil prices have been picking up, food prices have been picking up. So the food and energy component of inflation, you know, it's probably the area where you'll see most of that occur. Outside of that, I think it's less clear, you know, because if you think about the main areas of service sector inflation, one is medical costs. There's been a big spike in medical costs this year because of COVID. That's probably going to start to head down. The other is education. So, our educational establishments, are they going to increase their prices in the years to come? I doubt it, especially with remote education and so on. Then there's a big one, housing. Is our sort of rents are rents going to pick up significantly going forward? Or instead, are we going to see a move out of high rent locations like cities towards lower rent places, which will then have this disinflationary impact?
And we've seen, Bilal, Philip Lane, chief economist at the ECB, just speaking in the last minutes, saying that it is essential not to let the yield curve steepen prematurely. And I guess this feeds into the inflation conversation, doesn't it? The extent to which central banks are going to be desperately trying to keep yields low to enable all indebted parties to pay back those debts.
Yes, absolutely. And Europe has a chronic, low inflation problem. I mean, core inflation is around 0.2, 0.3%. I mean, it's anemic, the inflation there. So Europe really does need to do whatever it can to sort of boost inflation. And, the importance of the yield curve is that, if you have inflation so low, if the yield curve steepens a bit, you end up with positive real rates in an environment where you really want to boost your economy. So this is the message from the ECB that they really want to keep policy very loose, keep the yield curve low to really, allow consumers and businesses to have the best interest rate environment possible.
Bilal, thanks very much. Thanks for joining us. Macro Hive's Bilal Hafeez, thank you very much for spending this period of Thanksgiving with us.